Hey everyone, this is Kirk here again at OptionAlpha.com. Thank you so much for joining us again tonight for the video recap that we do here each and every night on the membership side of our blog. So what we do in this video is we go over both the opening and closing or adjusting trades that we made today. Again, these videos are only sent out and these alerts are only sent out to just our members who are part of our membership site. If you're seeing this on YouTube or somewhere else publicly online, you're getting this video about 7 to 10 days after it goes out to just our members. So you can't take advantage of these trades without signing up for a membership first. Now today we're actually pretty active with trades. Yesterday, which is kind of odd for us, but we actually didn't even have any trades yesterday. No opening trades, no closing trades. Today we had 6 trades that we entered. So I want to go over those tonight here in the video, and in particular I'm going to cover the butterfly in FXI because that's a little bit of a different trade. It's not our usual credit spread, debit spread, iron condor. So I want to go over that one specifically because it's a broken wing butterfly, and I think it's a really good example of how to enter those trades. So first I want to talk about the closing trades that we took off here today. We bought back, the first one is UNG, this is natural gas, and we bought back our 26-27 call spread that we had originally sold. Now this is a March contract, and so it got down to a 10-cent debit. So as soon as it got down to a 10-cent debit, we already had an automatic order that was in the market and had been working for the past couple days to exit this trade and take a majority of the profit. So you'll see that we made a $21 profit per spread. So we got rid of all 6 spreads that we had. So it was a nice, big, healthy profit for the trade. But the whole idea here is that we exited the trade early. As soon as UNG popped down lower today, it gave us a really good opportunity to get rid of the security that we already had and move on to other trades. So we had originally sold the spread somewhere up here, and now that UNG had moved down, that gave us a great opportunity to get rid of this call spread. And you'll notice too that implied volatility has also gone down as well. So that obviously was going to help our credit spread position. The other trade that we got out of today was Priceline. So we had originally bought a put spread in Priceline, the 1370, 1360 vertical put spread, and we paid about 510 for the put spread, which is almost half the width of the strikes. And we usually like to do that because we want this to be a 50-50 trade. Priceline was trading really high, and we wanted to take advantage of the move down in Priceline, and that's what we did here today. So we got rid of it at a 620 credit, so we took a nice $110 profit. Now the max profit on this, if we held it all the way through expiration, which is again back all the way in April, so we would have had to hold this thing all the way through March and all the way through April expiration. But the max profit on this trade would have been $490. But since it was a 50-50 probability trade to begin with, because we paid about 510, our risk was about 490, then we actually ended up kind of breaking the cycle of odds, of that odd probability that we talk about, where you make high probability trades and you make trades like this, which are actually kind of even probability trades, but you break that cycle of losing trades by taking profits on these trades early and getting the money off the table. So that's what we did here. We exited early. It was a nice profit of $110, nothing to write home about, and also reduced our negative delta in our portfolio because we're no longer short Priceline. So if we go to Priceline, you guys can see exactly what happened in Priceline. We actually shorted it via the vertical debit spread back up around here. I don't know if it was exactly the high or not, but it was very close to up here, and we've only held on to it for a couple days and just taking advantage of the down move that it's had. And again, you'll see that it wasn't a very big move, and we didn't expect it to continue much lower than this. Some people are trying to hold on to this thing, but I'm just going to get rid of it at this point. It's not a high probability trade, so if we made a little bit of money on it, that's exactly what we want to do. Keep active and take those profits off the table. All right, on to the new trades that we made today. We had a couple of vertical credit spreads that we sold. The first is in P, which is Pandora, and you'll notice that we're definitely staying with the April contracts here. We're pretty much all of done with March. We entered just one March trade back earlier in the week in Facebook, but basically everything that we're entering now is for April, rolling out to the next contract month. You'll notice for Pandora, we sold the 32-31 credit put spread, and we took in a credit of 25 cents. So that's about 25% the width of the strikes. Means that our probability is 75% chance of success and about 25% chance that we're going to lose money on this trade just based on where the pricing is for where we entered the stock. Now, if we actually go to Pandora, Pandora's had a pretty rough time here in the last couple of days. Oh, excuse me, on my cursor. And Pandora's had a pretty rough couple of days here, and you'll notice that the stock's been really beaten down. And when we actually entered this trade, Pandora wasn't trading as high as it did at the end of the day. So it actually rallied after we made this trade, which is great for our position. But it was actually trading about neutral around 34, and so we sold the 32s, which are right below there, as our first strike. So it gives us a little room between us and the market. And at the time, implied volatility was above that 50th percentile that we always talk about. So on top of that, because the market rallied and implied volatility dropped, we already have a nice little profit that we're starting to bake in for Pandora, and that just helps. It also gives us a little bit more positive delta in our portfolio, which we definitely need, considering that we're still tilted a little bit bearish. We're starting to neutralize that bearish tilt over the last couple weeks, but we still need a couple more positive positions in our portfolio. The next trade that we entered here today was another positive delta trade, and that was in BAC, which is Bank of America. We sold the 17-16 put spread and took in a credit that was a little bit better than the put spread we sold in P, which is Pandora. And we took in a credit of 27 cents on just a $1 wide put spread. So same thing here with Bank of America. Really been beaten down. Implied volatility was high, still remains high. And so over the last couple of days, just been beaten down a little bit. So we think even after this big move higher in Bank of America that the stock may continue to move higher. It is off of the lows today and where we sold it. You'll notice up here in the top left-hand screen that implied volatility is at the 52nd percentile. So it is just above that level that we need it to be at in order to sell any type of option strategy, whether it's an iron condor or a strangle or a straddle, whatever the case is. You want implied volatility above that 50th percentile so that the odds of success are on your side. And so what we did is we sold the 17, which is just below where the stock was trading today, the 17-16, and that gives us a nice wide range here below the stock to make money. Our break-even price is down right around around 16.75 or so. And so that gives us a little bit of cushion between where our first strike is and break even, helps us realize some movement in the stock before we get into April. But of course, we do want this thing to continue higher, and that's what we think it's going to do. So we're just trading a directional side of the trade. You could easily have sold the call spread if you think Bank of America is a little toppy and looks like it could continue lower. But again, we needed some more deltas in our portfolio to tilt us more positive. All right, so on to the last trade here. So this is a trade that we made here today, and this is a butterfly spread that we bought. So follow me on this. We bought 2 of the butterfly spreads in FXI, but we bought them for a credit. And so the reason that we got a credit is because we have on our hands a broken wing call butterfly. So what does the broken wing mean? And we do video tutorials about this, and there's a ton of them you can go look at. But basically what we did is we skipped a strike when creating this butterfly. So a normal butterfly would be 33, 34, 35. So very evenly spaced options. In this case, we sold or bought the 33s, sold 2 more of the 34s than we bought, and skipped over the 35s and bought the 36 call options. So you'll notice that we skipped over that 35 strike, and that's what creates that broken wing or that kind of unbalanced butterfly, as some other people call it. And by doing this, by moving out past the 35 and buying these cheap 36 options, then we actually get a net credit on the whole position. So what that basically means is that we took in a credit to begin with. And so that leaves a bigger and wider opportunity to make money on this trade. So what does this look like? So first, let's go to the actual Analyze tab here on Thinkorswim. And I like to use this all the time because it really drives home exactly what we're looking at here with this butterfly. So let me just adjust it here so you guys can see it. But this is our butterfly spread for FXI. And you'll notice down in the bottom left-hand corner, as always, our trades are right here. So we sold 2 of these, or I'm sorry, we bought 2 of these for a credit. That means that we actually bought 2 of the 33 calls, sold 4 of the 34 calls because you sell twice as many as you buy, skipped over the 35 strikes, and bought the 36 calls. Now here are the individual prices for all those securities, but at the end of the day, we took in a small credit of $5 per spread that we got into the trade. Now, if we actually take a look at the profit loss diagram, you'll notice that the butterfly spread actually has this broken wing. So it goes like this. This is what our profit loss diagram looks like. It's centered around 34, which is our short strike. And then as it goes towards 33, it stays above the break-even line, which is 0, or the neutral line. So you'll notice here that anywhere above 34 will make money on this trade. Now, the trade is really centered, and this is where we make the biggest chunk of money. We make the biggest chunk of money around 34. But you'll see that, anywhere below 34, excuse me. Anywhere below 34, that's where we make money. But you'll see this trade is centered around 34. So if the stock were to close exactly at 34 in April expiration, that's where we would potentially make the biggest chunk of our money. And it's not to say that we think the stock is going to do that. We just want to take advantage of possibly some downside movement in the stock. We don't want to just pin all of our hopes around 34. So if we had traded a regular butterfly, we would have bought the 35s, and that would have made this butterfly look a little bit more like this, more like a pyramid, kind of on your profit loss diagram. And it would have absolutely centered the trade around 34. So you're giving yourself a small window of opportunity to make money. But in this case, we took in a credit, so that means we could actually just leave this position on, and if FXI continues to drop, we don't have to do anything to get rid of this trade. We just keep our credit. Now, we don't really want that, and that's okay if it does, and we take in a nice little credit, and it's very small and basically covers commissions. But ideally what we're doing is just giving ourselves a little bit more opportunity to make some money on this trade, even if it is a small credit that covers commissions. What I don't like to see with some of the butterflies is that you make them even too early, and you give yourself a very small window of opportunity to make money. And that's just not realistic in most markets. Markets are trading very, very fast, and it just makes it very, very tough. So our break-even point is out to 35.04, and that's basically where our 35.05 is basically where our break-even point is. So if I look at a chart of FXI, you'll notice that the Chinese index, basically the large cap ETF here, has had a really tough time, and it could potentially continue lower. Now our break-even point is just above 35, so that's basically the line in the sand that we have here that I'm drawing. So that gives us plenty of room for this thing to rebound, even in the face of the last couple days where it's sold off dramatically, and then still either trade sideways or continue lower for April expiration. What we don't want is, obviously, we don't want it to go above 35.05. In that case, we'll start losing money on the trade, but that's okay. We're still taking a nice calculated bet here on where FXI is going to go. Now, the key to doing this butterfly spread, as always, because we're a net seller of options, is this implied volatility percentile. It's above the 50th percentile, and today when we entered the trade, it was at the 56th percentile. So it's a little bit higher than what we've seen regular in the market. So what we regularly see in the market is stuff just above 50, and there just hasn't been that much implied volatility lately. But to see something up around 56, 57, even towards the 60s, that gives us a good opportunity to change up our strategy and create some different opportunities with different option strategies. So not trading the same old, same old. And so hopefully this has been a really good example of how to trade a broken wing butterfly. Now, as always, I hope you guys enjoy these videos. Please add your comments or questions below the video. I'll get back to all of those either tonight or tomorrow before the open, and happy trading.